In a 2-week period, I lost over $50,000. I went 0 for 18 on my trades with a 0% win rate. Imagine losing 18 trades consecutively with not one winning trade. Yet I still ended the month up $41,000. And I had a 28% win rate, which is significantly lower win rate. But the point of this is I ended the month green. Now in this video, I want to break down the first 2 weeks of April of how successful it was, how I followed my plan, and I implemented this strategy that I'm going to explain to you all watching this video right now, and how I ended the first 2 weeks with a $91,000 profit and a 70% win rate. These are excellent stats, and my P&L curve was like an uptrending chart. Versus the second 2 weeks of April, things started to take a turn. I was not following my rules. I was not following the strategy that I'm gonna explain to you all in this video. And my trades took a hit due to a lot of emotional decisions that caused a lot of frustration and a confidence hit in my trading. Yet ending the month green, I wanna discuss how I kind of turned around my trading and how if you are all going through a similar aspect in your trading of drawdown, you're losing confidence, you're making emotional decisions, you can't protect your losses and your wins are not outweighing your losing trades. I want to discuss what I do and how I view certain things. That way, if you're going through something similar, you can get over it and start seeing a major difference in your trading. The number one most important priority of any successful trader, short-term, long-term, swing trader, futures, options, stocks, Forex, has to be risk management. And this is so important to whatever strategy you use. So let's break this down again into the first 2 weeks and then the last 2 weeks. The first 2 weeks looked like a solid uptrending P&L curve. And in these first 2 weeks, I took 13 trades, and out of the 13 trades, only 8 of them were winning trades. Versus the second 2 weeks, I took 18 trades, and all 18 of them were non-winning setups. So splitting this P&L calendar up right here, we had basically 8 wins in the first 2 weeks and 18 losses in the last 2 weeks, and this chart was like a downtrend. This goes to show you that at the end of the month, when you add all winning trades to losing trades to break evens, having a 28% win rate, I still ended the month up green. Now, emotionally, it's frustrating, it's damaging, you take a hit in your confidence, and I'm gonna explain like the pyramid structure of risk management being number one priority once you have a solid trading system. Because my average win to loss was a 4.2 to 1. My average win was $12,000. And despite taking 18 losing trades, my average loss was only $3,000. Any successful trader, no matter if you have a 70% win rate, a 30% win rate like I have here, your wins have to stack up that look like an uptrending chart, and your losses cannot look like a falling knife or just you're falling off of a cliff chart where you significantly sharp in your profits down. Having losses and taking losses in a monthly period is fine, it's inevitable. But when the losses are controlled and they are very, not sudden, but kind of slow to the downside, this means you are just implementing proper risk management instead of taking a huge one-loss hit, wiping away, call it 8 wins of profit. Losses are easier to take when you put risk management first. Number one, strong foundation of a trading strategy. I'm gonna highlight to you all 2 trades that I took this month that were basically the whole playbook of all the setups that I took. Every successful trade that I took this month had to do with this strategy, and it's such a strong foundation. Now, when you implement this strategy and you focus on risk management, there's no such thing as blowing up trading accounts. I don't want to hear anybody, if you watch my videos, if you're a follower of me, I don't want to hear the word, I took a large loss. I don't want to hear the word, I blew up my account. That is non-existent when you put risk management first. So if you ever blow up an account or you ever take a large loss, that just means you're not implementing your risk management. Looking at my trading, and even though I went 0 for 18, my losses were nowhere near some of my biggest wins. My biggest wins, look, $28,000 profit, $17,000 profit, $21,000 profit. And look at some of my losing trade days. Some of my days where I took 4 losses in a row were only $9,000. 3 losses in a row were only $8,000. the losses are significantly lower than the wins because I obey my stop loss and I don't have a large loss in my vocabulary. And knowing this in the back of my mind, it makes losing, I don't want to say good, but it makes it easier to lose, and you have to be a really good loser in order to win. And this just keeps my emotions in check more often than not. On top of this, each loss will just serve as an important lesson, and you can do this by knowing how much money you're willing to risk before you enter that setup. Before I enter a trade, I know, okay, if I'm wrong and my stop loss hits, I'm only gonna lose $4,000. If I do it twice, I'm gonna lose $8,000. And I know how much I'm gonna lose before I enter, which does not make any surprises, and it makes large losses kind of, I don't wanna say impossible, but very difficult to occur. And on top of this, we have to approach the market with my 2 steps forward, 1 step back. Point number 5 is crucial here because this is the most important aspect of risk management. What I mean by this is when we win, we take 2 steps up, and when we lose, we only take 1 step back. When we win, we take 2 steps up. When we lose, we only take 1 step back. We consecutively do this, our chart is gonna look like an uptrending chart. This is worst case scenario. Again, we wanna take 2 steps forward, minimum, and 1 step back, maximum, meaning sometimes our wins are gonna be 4x, meaning we go up 1, 2, 3, 4. Now we're up significantly. Okay, we take a loss, we're only down 1. We take another loss in a row, we're down 1 again. 3 losses in a row, we're down again, yet we're still green and we're still profitable on this account despite 3 losses in a row. And I think this month was a good aspect to this, where I took 18 losing trades in a row, which again, I'm gonna highlight my mistakes, not so much strategy, more so emotionally. But despite going 0 for 18, I still had the first 2 weeks that outweighed the last 2 weeks. Now let's talk about strategy. This is again gonna be in the first 2 weeks. This first setup was a $17,000 profit. It was a 3.5 to 1 realized risk to reward ratio where the market was selling off into this level of demand, and I took the market long on a break and a bounce of this level of demand and taking profits on the way up. Now let's talk about the strategy a little bit in depth. If you're new to my channel, check out the links in the description below of this video. You could follow me on my Instagram. I post daily trading recaps on there along with really good trading tips and tricks. Along with, I'm gonna post my order flow series, which kind of will explain these things further as well. But in the first 2 weeks, the strategy that I used, that I implemented, that I found the most success with is what I call LVN. It's essentially this 4-step process of letting the market bounce off of a level of demand. And on the bounce up off this level of demand, we have to identify strong buying or selling volume. If we're looking to short the market off of a level of supply, we need to identify strong buying or selling volume. And then on this rally or on this drop from demand or supply, I look for ranges where price did not transact much volume, leaving an area of low volume by price. And then I wait for a pullback into this range to gauge if those buyers or those sellers are willing to defend price. The best part about this strategy is not a lot of it could be found off of a candlestick chart, and it's best by just reading the volume that comes into the market, which I'm a big advocate of because it just gives us the raw, most authentic part of the market. So in this example, we see it selling off into this level of demand at 56.02. A scenario that I was watching for was if 56.02 demand trades, I want to play long, targeting a level of resistance up here around 56.21. Now the market bounces off of this level of demand, and I did not get an entry long off of this level. Instead, I waited for the market to bounce, and we form, again, what I mentioned as a level of low volume. So keep in mind, 56.02 is this level of demand. This is a picture of a heat map. Again, if this confuses any of you, I would really just recommend checking out the order flow series on my channel. The market rallies up, and on this rally up, looking at the volume profile right here, we could see around 56.15 to 56.09. This range that I just highlighted right here is an area where volume is significantly lower by price. So the idea here is the market just bounced off 56.02 demand. There's large buyers here because the market is lifting and rallying up higher. And now we're leaving a trail of low volume at 56.15 to 56.09, where I look for the market to dip down into this, where I could capitalize on a bullish long position to the upside. Now here's my plan. The market pulls back into 56.11. I take the market long here, 56.11, having a 5-point stop loss. going for about a 14-point target up into this level of resistance around 56.22. Now we pull back sharply and aggressively into this level that I just mentioned as the low volume. This concept of this strategy is not so much getting long at the level of demand, but rather getting long once the buyers prove strength or once large participants are factored into the market. And here are my fills. This is the $17,000 profit, 3.5 to 1 realized risk to reward ratio. I got long down here when the market dipped into 56.11, taking profits on this resistance break, scaling out along the way, and then scaling more out on this high right here where we broke above this high and I got out of my second scale up here. Taking profits at levels of highs, at levels of low, or anywhere where the market can reverse. So the whole concept of this is validating buyers are strong, and then waiting for the market to pull back into these levels where these buyers are factored in at or where these buyers or sellers are seen at. And then as long as that level holds, it would be safe to say point number 4 is validated and these large buyers, the large sellers, if we're talking about supply, are defending price, and then we can follow their footsteps. I think these are 4 crucial aspects to this strategy. Now here's another trade that I took. This was April 10th. Same strategy, just flipped to the downside. These are parts of my playbooks. These are very successful, what I call low volume node. Again, anything that is a part of my playbook, anything that is a part of my strategy, when I see it in the market, I take it. This was 7 contracts on ES futures, a $15,000 profit, and a 4.5 to 1 realized risk to reward ratio. I think executing off of this strategy enables me to have a better risk to reward, which then just enables me that I don't have to be correct most of the time, as you saw with a 28% win rate this month. So here the market forms this level at 53.60 where we get a pop into it and I get an entry short as it's rallying into this level of supply, again for a $15,000 profit. Now, what I said earlier is we want to see the market reject off of supply or bounce off of demand. In this example, the market has this level of supply where we are selling off from and we are placing lower highs, lower high, lower high, lower high. Now the market's selling off from this, and when the market opens up, it forms a level at 53.60 that I was watching for a rally into this level to target the 56.10s or 53.10s, which was the low of day. So 53.60 becomes a level of interest. We are looking for the market to pop into this, to sellers, for them to appear, to play short, targeting the low of day. The market, where this level came from, was again pulling up a volume profile. We could see 53.60 right here to 53.70, 53.75 as a general range of low volume. Where I'm highlighting in here, the market, based off the volume structure, is significantly lower in this range, indicating the market moved through this level with ease, just indicating that why this level formed was because of aggressive participants. And in this case, since the market sold off and moved lower and rejected supply, these aggressive participants were safe to say that they are sellers. So the idea is to wait for a rally or wait for a pop into these 53.60s where we could look for sellers to reappear to take the market short. Now, as we come into 53.60 here, we could see the bubbles just represent buying and selling volume. When there's large red bubbles, it just indicates that the selling is stronger than the buying. When there's large green bubbles, it just indicates that the buying's larger than the selling. In this example, as the market rallies into 53.60, we can see point number 2 here. There's a large red bubble here as the market is moving up. If we see the market moving up, ideally you want to see a lot of green bubbles. But in this example, the market was moving up and there was a lot of selling pressure here at point number 2, which just validates that the sellers that I spotted earlier at this range are continuously looking to sell the market, where I take an entry short here at 53.60, placing my stop loss above the 53.75s, which was this previous high, targeting the low of day, which we could see my last exit was under this low of day here. And this was a $15,000 profit or a 4.5 to 1 average risk to reward ratio. And those were the successful setups that I used in the first 2 weeks. I could show you all different trades from all different days that I had a green session that was just following this simple strategy. But now let's talk about the next 2 weeks to follow this. Now, after having a successful first 2 weeks, I felt really good about my trading. I was like, I'm up significantly on the month. I'm very comfortable. And truthfully, I feel like after a very successful patch of trading, the market could easily humble you. So if anybody goes through a successful trading day, a successful trading week, a successful trading month, just know that if you want to be cocky or you think you're the best trader, the market could easily humble you, especially that the market conditions are always changing. If we're not susceptible to change and we cannot adapt, then we're just going to get left behind in the market and we're going to see a lot of struggle. So because of me trading so well, after April 15th, this is when the days started to get really bad. April 16th, if you were to look at all these trades, what I kept doing was I kept taking the market in the direction that I thought it was going to head. I could not even label a playbook here. I could not tell you all what type of trade I was taking here before I took it. This was a $500 loss. The next trade that I took was a $3,800 loss, and it was the similar thing. It was just shorting the market. Let's go to April 17th. April 17th, I took the market long with no reason. There's no playbook here. I couldn't tell you all, looking back at this data, why I took the market long. All I know is that I was taking trades because I thought the market was going to move in the direction that I wanted it to go into. As traders, we want to see what we think is going to happen. And we want to look for what we think is going to occur next. And the market doesn't care about our feelings. The market's going to do what it wants to do. So we have to listen to the market instead of listening to ourselves. Our thoughts, our feelings, our emotions is not going to control which direction the market's going to head. The market will determine which direction it's going to head, and it's our job to read the market and understand the clues that it's telling us to put high quality trades on. And truthfully, in the last 2.5 weeks of April, I could not tell you all one solid setup that I took that was based off my strategy or that was based off of my playbook. Here's a long position that I took, $1,700 loss. The same day, April 17th, another long trade that I took. A few minutes later, a $4,200 loss. Same exact thing. On Thursday, April 17th, I took another long $2,000 loss. My issue was I was taking a setup that I thought was good. I thought the market was going to move in that direction. It did not work out on me. And I kept trying to revenge trade to make the money back and, most importantly, try to be correct on my analysis. Because I traded so well the previous 2 weeks, I felt like I was always going to be correct, especially with the 73% win rate that I had. And I felt like even if I took a loss, let me try it again, let me try it again, let me try it again, because I want to be right. And my ego was saying, I want to end the day green, I want to end the day correct, and I want to walk out of my office knowing that I just nailed the market direction, and it just was a domino effect that amplified 18 losing trades in a row. Like, look at this day. This is April 24th. These are all short positions that I took. One was a $1,500 loss. No reason behind this. Truthfully, I approached every day, and I remember this vividly a few weeks ago. I was just having the itch to trade. I was having the itch to make money. I was having the itch to be correct. I was having the itch to have risk on because I wanted that dopamine hit. I wanted to feel good at the end of the day. I wanted to be right. And I loved the feeling of the dopamine that I felt in the first 2.5 weeks. And me not feeling that dopamine after being wrong, I tried to do everything to be right to feel that dopamine and feel on top of the world. $1,500 loss, $3,000 loss. Look, just shorting the market for no reason. Next trade, $3,500 loss. Shorting it again 2 minutes after I took a loss. And then the fourth trade that day, the same exact thing. A few minutes after I took the loss, I shorted it again and I took a $3,000 loss. So the losses just were amplified. It was not based off of a strategy. It was not based off my rules. I did everything wrong and went against everything that I preach and everything that has got me to where I am as a trader. And that's fine. The drawdown's normal. It's just recognizing the mistakes, having the backbone of risk management to protect me, and most importantly, learning from the losses that I explained to you all earlier. And take a look at this. Despite even taking a good setup, let's just say, my emotions were all over the place. That basically just screwed me up. This trade, at one point, I was up $15,000. Yet I closed this trade up only $2,400. This was on Friday, April 25th. Look at the next trade that I took on Friday, April 26th. This was a $2,600 profit. Look at my entries and look at my exits up here. I entered short, stopped out on the green candle for the market to eventually move in my direction, and I would have profited on this setup. The next trade that I took on April 25th, look at this trade. perfect entry short at the highs. The market dropped, it hit my target. I was up $20,000 this day. In 10 minutes time, I made $20,000. But I did not sell at my target. I got greedy. I wanted to make more money, and I stopped out of this trade for a break even. Imagine being up $20,000. And again, this is just me being vulnerable and showing you all that my emotions were my greatest enemy in the last 2.5 weeks. It was a domino effect that spiraled certain trigger patterns that just did not benefit me at all. Imagine being up $20,000 in 10 minutes for that trade a few minutes later to go break even on you, and you missed out on $20,000 that you never had. It's frustrating, and the biggest aspect to this was I was greedy, I was fearful, I wanted to make my losses back, I wanted to make the most amount of money, and just my emotions were doing the trading. I felt truly like a puppet, and I'm sure a lot of you watching this video could relate, where you feel like a puppet. You feel like you are being controlled by your emotions. Your emotions are doing the trading for you, and you're just a body that is clicking buttons on your keyboard. We have to flip that. We have to control, and we have to let our emotions be controlled by us. And we have to let everything that whenever something negative or bad comes in our mind, to let it go and control it as best as we can. So a couple things that I've learned that I want you all to implement is that, number one, when you have a solid system and you have a solid strategy, use that as your backbone to your trading. Your system, your strategy is not going to win you 100% of the time. In fact, if you build a system that loses more than 50% of the time, yet you implement proper risk management, in my opinion, that's a win. And I think my trading performance is a very good example of that. But when you have a strategy, you need to follow that strategy and act like I am watching you trade on a daily basis. And this is kind of what went through my head when I was sitting here, because now, to start May, I'm up $43,000 and I haven't had one single red day so far. So what I did and how I implemented this to kind of see a difference in my trading was I'm acting like someone is here watching me. And if I can't explain to whoever is watching me, and for everybody watching this video, act like I'm watching you. If you can't explain to me why you're taking that setup and label the playbook or label that trade, then just know it's a setup you should not be taking, and most likely you're acting upon emotion or you're acting upon impulse, which is what I did in the last 2 weeks of the market being open. When you implement proper risk management on top of this, there's no such thing as a blow up. Despite me going 0 for 18 and struggling in the last 2 weeks, there wasn't one trade that in one trade itself did I lose over $10,000. I may have lost over 5 figures in a day, but not one trade was significantly larger than some of my lowest losing trades. And this is the 2-step forward minimum, 1 step back approach maximum that I'm explaining to you all. And just review your data, like reviewing my data and accepting the mistakes, knowing they're not permanent, they are temporary. Anything that I go through that is an error or a mistake, just know I can learn from it, use it as a lesson that I can implement and start seeing a difference in my trading, which I am seeing in the month of May so far. Think present moment. Think what I did last month happened. I don't want it back. Let me learn from it. And what's happening right now, I can use to my advantage. The best moment is the present moment. And the market gives all the answers we need right now. As long as we're not thinking about the future, how much money we can make, how much money we're gonna lose if we're wrong, we're thinking about the future, it's non-existent, we can't think that way. Any mistakes that we made in the past, as long as we learn from it, we can use it in the present moment to our advantage and not think so much in the past that's just gonna damage the present moment. So think present moment, review your data, implement proper risk management, and act like I'm trading right in front of you, that you can tell me the setup that you're taking before you take it. So I'm gonna end the video on that note. If you enjoyed this video, let me know by dropping a like, comment any questions, and definitely check out the links in the description of this video. If you're new to my channel, hit that subscribe button. I'd really appreciate it. But I'm ending it. Peace out.